The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady. And we got lots of stuff to talk about today, and we would love you to become part of the show. 803-0930, 803-0930, star 930 in a cell phone. That's how to get into the studio. And we got all, there's it's like peeling back an onion. We're finally getting to some of the other things that are happening in the tax laws, and you are the smartest taxpayers in the world, because you get to listen to our show and call in every week. So, and I'm joined in studio with Tiffany Fabian. Hey, Tiff.
Hey there, Esther. Happy Saturday.
Happy Saturday to you. It's chilly out. And Mr. Fabian. Hey, Chris.
Hello, Esther.
Hello, Christopher.
I thought you needed a key to get into the studio.
Okay.
You said to call to get into the studio.
Oh, well, because they are wonderful.
I know, I'm just being
and
me.
I just want to express my condolences to the terrible tragedy that happened in Pittsburgh.
Synagogue.
We love our Jewish brethren, and it's just a horrible thing. I mean, it's like these crazy people, they don't care who they kill. There's just some people that don't like this group and that group,
Right.
and it's a shame what's going on in the United States. But
All over the world.
Yeah, that's true. But I think it's more heightened here because we have so much media that want to talk about it, right?
Yes.
But more than anything, it's a horrible thing. You go to church or your synagogue and you go to worship, and you got to worry about somebody coming in and shooting you.
It's
So
not
anyway,
good.
but Chris, you did what you said you were going to do last week. We had a stumper, somebody that stumped us, and so you did the research on that real estate program. And I think it's
did.
important, right, for people that are listening, because it is a big savings.
It is. It's the form RP 425. What they did is they broke off. It used to be a combined enhanced star and this program to help with your county tax and village tax if you're in a village. But they have separated it, and now you have to fill out the RP 425.
Now, you get that where, Chris?
You get that right from your town. You have to go to your town to do this. There is an application.
So let's put the perimeters so everybody's now going to their town if they won't qualify. There is an income breakdown.
There is. Usually what I call like 5 or 6 towns, and it's usually capped at $35,000.
And that includes your Social Security.
That includes all your Social Security. You can back out your IRA distribution, but you have to add in the increase in value of your IRA.
Okay, so you got, let's say, $20,000 in Social Security. You took $15,000 out of your IRA. That doesn't count, but your IRA grew by 10. So you'd have the Social Security plus the growth. That's what they look at. And if that were over that threshold figure, you're not going to qualify. But to make sure, you should talk to your town.
Yep, just call the town assessor. That's who I talked at.
And
Talk
these
to
are,
her.
of course, this is property tax. This is not income tax.
Correct.
Right?
This is just property tax. This is not the STAR program. This is on top of the STAR program to help with your county and your village tax.
Cool.
Okay, so thank you for the gentleman that called last week that alerted us to that. We try to be on top of
new
everything
program?
tax related. We are really income tax and state of New York tax, but any taxes we want to help you with. So if you got another one, let us know, because we will research it for you. Anything else, Tiff, that you have that you want to add?
Our Saturday class is starting today. So, if you still want to learn taxes from A to Z, great opportunity to do that. And I just just encourage. I talk to people all the time who haven't filed their return for many, many years, and we seem to specialize in that because we do it at a reasonable price, and we don't make you feel belittled. We just build you up and say, let's get this done. So if you haven't filed or you need to do an offer and compromise.
Your tax psychiatrist, right?
Yes.
You end up getting into your head to straighten it out so that it doesn't happen anymore.
Yep.
Right. And let's not forget our EG Health Connect with Medicare.
Right. Yep.
You know,
Plan B.
Plan B, if you're over 65 or older, it's now open enrollment for that. Tim and his team is there to help you. And it's not just this time of year. When you're turning 65, you have to do that too. Or maybe you just retired and you were getting health insurance from your job and you're 68. Now you have to go on Medicare Part B.
Or if you're on the marketplace, you have to renew, or you might want to take advantage of the New York State marketplace and get health insurance at a great price, possibly.
I'm getting a robocall here as we speak. The other thing I wanted to talk to people about is that we have a wonderful change in our corporate headquarters, right?
So exciting. Maria and team over there at 1890 Colvin, our new headquarters, has been working feverishly, and we are so excited. It's a great location, lots of parking, and it's one
and that
exit
was really
down
our
from where
impetus.
we're.
Our poor clients had to crawl all over the parking lot last year to get parking for the last few years. And so this parking lot has parking for 50, so nobody should have to wear their snowshoes to come in to get their taxes done.
And when I know selfishly, when I work from 8 in the morning till midnight, I actually get a window in my office. I'm so excited.
Actually, you have the best window.
I know.
You have the best window.
I'm so excited.
Okay, I'm Esther Gullius, the tax lady from EG Tax. We are going to give you this big capital gains break that after we talk to Larry from Georgia, and so you got to be tuned. If you got a bunch of capital gains, we may give you something that'll save you lots of money. But in the meantime, our buddy Larry from Georgia. Hey, Larry, how can we help you, sir?
Well, darling, how are you? Asher, first let me say thank you. It was very, very sweet of you to mention the situation. And if I could just say that, you know, while I don't believe in an absolute unconditional right to bear arms, I think if we have more good people having arms, it may help deal with the bad people. That's just my personal.
Mm-hmm.
Well, you know, it's true. I mean, you think about Chicago; they're the toughest gun laws, and they have the most murders.
Right.
So, I mean, you can't. A person that is, whatever, you know, mentally deranged, that's very difficult. But, you know, when you're at your synagogue on the Sabbath and you are worshiping, you should not have to worry about somebody coming in and shooting you. And so, but anyway, Larry, but you got a tax issue?
And this Esther, I do. I called early because I've got three what I call bullet questions, so I'll be very fast. You know, I'm still self-employed. I've got one client left, so I'm making a little income. I'm just curious about the 20% pass-through for self-employed, if that might be appropriate for me. Number two, I want to ask you your opinion in general about opportunity zone investments from a tax.
Larry, you're stealing my thunder. That's the next thing we're talking about is opportunity zones. So you got to stay peeled for that. But obviously, if you have a net profit from your business, you're going to qualify for the 20% pass-through after your itemized deductions or standard deduction. So if your net profit is $20,000, you're going to have a deduction of $4,000 after standard deduction or itemized deduction. And then you got to just stay peeled to listen to our thing on the opportunity zone.
Which is pretty cool because he gets that on top of the lower tax rates. So it ought to be a better answer for you in 2018.
Okay, Larry?
Okay. I mean, can I ask one last one?
Of course
Sure.
you can.
Right. Thank you so much. You know, I'm in Georgia, and I just discovered that my state has a tax credit, up to 5,000 tax credit, where basically you give a donation to a rural hospital, and you get a credit for that. And if it's more than what you owe, you can pass it to the following year.
Right.
Just wonder if,
Carry forward.
Chris, if you think that might be a good idea for me, tax-wise.
Well, it's all going to depend. I know what your current health situation is, all that, and it's all going to depend on how your investments are going to do for you in the future. you
And
know,
of course,
if you're going to
a
need
credit
that.
on a state tax return, which has such a much lower tax rate, you have to balance that out. Like, for instance, how much are you going to contribute to the item that's going to generate the credit, and how much you're really going to save. So I think that's kind of something that you and Chris want to talk about.
Yeah, call me on Wednesday, Larry.
Right.
But that's a good
Or
point.
Thursday.
Okay.
And then I also want to say that your health is going to be awesome and excellent, because
That's
that's
right.
that's what I believe.
I'm Esther Gullius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on your cell phone. Larry gave the intro. We're going to talk about how you can eliminate capital gains altogether through opportunity zones on the other side of the break. Hey, I'm Esther Gullius, the tax lady, and we want to make you smarter than the average bear on taxes, and we're going to give you a way so that you don't have to pay taxes on your capital gains. And it's a brand new change in the tax law. Right, Chris? Diff?
Yeah.
Okay, so let's say that you're sitting on $1 million in capital gains, and you think, "Mamma mia, it's going to cost me like at least $250,000, $300,000 to sell this, and I'll have to pay those taxes." But there's a way around it, and we've already talked about a tax-free exchange where you would take, like for instance, on a rental property, and you'd exchange it on another rental property or another depreciable business. This is similar to that, but this includes sales of stock. So let's say you got $1 million in stock sales, and up to this point in time, you just had to pay the piper. However, if you invest your capital gains into an opportunity zone investment, then, and you keep it in for at least 7 years, you save 15% of your capital gains. If you keep it in for 10 years, the whole thing is completely forgiven. And you know, when you take a look at Buffalo, which is undergoing such a renaissance, I mean, it is undergoing such a renaissance. Let's say that you had $1 million in capital gains, and you find a building downtown that you would like to rehab and maybe do apartments out of, or you want to do retail or mixed use, and it's for sale for $1 million, but the land that it's on is worth $600,000 and the building is worth $400,000. All you have to do is put in $400,000. They're not going to make you put in as much as everything, including the land. So now you put $400,000 in rehab into this project, and if you keep it for 10 years, you save $300,000.
That's
And
pretty
the
cool.
opportunity zones, you can get it on the New York State website. All you have to do is Google New York State Opportunity Zones, and I have to tell you, they're all over Erie, Niagara, Genesee County. I mean, it's a phenomenal way if you're somebody that says, you know, I'd love to get involved in some of this renaissance happening in the city of Buffalo or wherever, and I will tell you, I think Niagara Falls could use all the help it could get, but it gives you an opportunity to get rid of the capital gains altogether.
Yep. And
That's brand new.
The website is ESD, so Empire State Development.ny.gov.
All right, so you have to identify the property within 180 months, just like you would on an
180 days.
180 days. No, excuse me. 180 days, just like you would have to do on an exchange, and the renovations have to be done within 30 months. So I just thought that was important because there's somebody out there with sitting on a bunch of money and they're thinking, oh gosh, I don't want to do this. It gives you an opportunity to eliminate it altogether and make money on the back end on the other investment,
Right.
which I think is so cool.
It's unbelievable.
All right, and let's all talk about the other thing is kitty cat tax. So grandma and grandpa, we got grandchildren, and we say, oh, we want to give our grandchildren money, and so what we're going to do is we're going to take money out of our name and put it into the grandkids' name. Well, it used to be that if the grandchildren or any child between the ages of 18 and under age 24 claimed as a dependent on their parents' tax return made more than $1,050 in unearned income, they'd have to pay taxes at the parents' top rate. Not true anymore. How has it changed?
It is now taxed at a trust rate, which is much higher than a parent's tax rate. So the tax rate is going to be much, much more significant. And so you really want to pay attention or make some revisions if this is you.
Yep. After $12,500, it's 37%.
Right. So if the money that you've put in to your kid's account or your grandkid's account, if that money, and that would include sales of stock, right, Chris? Tiff?
Yes. Yeah, absolutely. That would
Exceeds
include.
that figure, they're paying at 37%.
Right.
In order to get to 37% on a regular tax return, you have to be making over $900,000. So you want to really think about, before you start plunking money into a kid or grandkid's account, that this new thing, it makes it simpler, but they pay more taxes.
Yeah, and
you might
even-
want to put it into an annuity.
And even excess scholarship money. So if you're a kiddo and you get excess scholarship money, you'll be privy to this kiddie tax, which is really detrimental.
I mean, and the kiddie tax has been here forever. But the change is the rate that you pay in taxes on the kiddie tax. So if your kids have a substantial portfolio, and they've been doing really good except for the last 2 weeks when the market's been taking a dumper, and they have all these built up capital gains and they're making lots of money, you might want to think about moving that investment maybe into an annuity. Because an annuity isn't taxable at all till you take it out.
Right.
So that's something you should do from a tax planning standpoint. You certainly don't want to find out that you're going to owe 22, 25, 37% at tax time on this kid's $10,000. You know, $3,700 is a lot of money.
Yep. Oh, definitely. I mean, here you're thinking you're saving money, and it's costing you guys a lot more money than it would be if you just left it in your own name.
That's right. So that's the new change in the kiddie tax. And we have Sue that has been waiting so patiently. Hi, Sue. This is Esther Gullius. How can we help you?
Hi, Esther. I'm an employer. I only have one employee, and he wants us to help him pay for health insurance. And he told me that he can get health insurance for $187 a month or something like that, and I can't find anything for less than $400.
Okay.
So I'm assuming that he's going on the marketplace or whatever, Obamacare kind of thing. Can I do that to get insurance for him?
Okay. You want to address that, Tiff, Chris?
Well, there is an employer. What's the word? An employer
package
that you can do through the New York State Marketplace. So your best bet would be to call on Monday and talk to Tim, and he can give you the details on how you can do it through the company, so then you can at least get the write-off.
Because she's the employee.
She's the employer.
But if you start providing health insurance for your employee and you have it fully funded, and he has to pay less than 10% to his own health insurance, then he has to go with your program. So you want to make sure that you do the due diligence to make sure that you do everything that you can to get the best insurance for the lowest rate, because obviously if he's getting better insurance for $185 through the marketplace, I guess that it doesn't mean you're a bad person. It just means that he's going to do better someplace else. And you can always give him a raise, but you cannot reimburse him for the health insurance. Correct?
No.
Correct.
You can't
reimburse
him.
him. Can I give him like a raise?
You can give him a raise, but it's not for health insurance. You have to give him a raise.
Yep. But the thing is, now
He
if
can
you give
spend it on anything, wine, women, and song. Right, but you can give him a raise, but you can't reimburse him for his health insurance unless you're doing it through that employer-based marketplace through the New York State of Health.
Okay.
Right, Chris?
Yep. I was going to say be careful with giving him a raise, because if he is getting it through a marketplace, then the raise could cost his health insurance to go from $188 to $220. So you got to be a little bit careful.
Right. You follow us, Sue?
Complicated. Yeah, I'm following you, but it sounds like it's so complicated because, what one hand does, the other hand gets slapped for it.
Well, and that's true, but you got to understand the New York State of Health really helps to subsidize people that are on the lower income end of the spectrum. So when you want to be a good guy and give him the health insurance, and you're not allowed to reimburse him for the health insurance, and you give him a raise, then that increases that amount of money that he got. So his help from New York State is going to be less. But that's only fair, right?
Yeah.
I mean, it's only fair. If you're giving him more money, the state of the people, the taxpayers in New York State should not be subsidizing him. But the bottom line is he's going to come out ahead. And so it's worth, and it's like anything. There's a learning curve with everything. Unfortunately, everything keeps changing so much all the time. It's like you're always on. You feel like that rat on the wheel. You just keep learning and learning and learning and learning, and they keep changing and changing and changing. But I will tell you, our healthcare navigator team is great, and they will sit you down and they will help you, and there's no charge. So,
Okay.
Just give us a call.
Right, thank you.
All right, thank you, dear.
Esther, you were talking about switching gears, New York State and the Opportunity Zone. There's another nice credit that New York State has, and that's if you're a volunteer firefighter. There's a $200 credit for our volunteer firefighters out there, and if your wife is one, you'd get $400.
And that's a refundable credit.
Yeah,
so it's a credit that they give you money back for, just because you're doing a wonderful thing.
Yep,
Right.
Yep.
But of course, so many of our firefighters in Western New York are volunteer.
That's
They're not
right.
paid. I mean, in the city of Buffalo, they're paid, but all of the suburban areas, you got these great people that come out, whether they're in the auxiliary or the firefighters, and they are just volunteering their time and risking their life.
Yes.
And what a wonderful thing.
Yep. You said it.
Right. So do you guys know what the name of that form is? What the credit form is? in New York State?
248.
So IT 248. If you haven't, you've been a annual firefighter or even EMT, correct?
Right. That's right.
You would get the refundable credit on New York State. If you haven't done it in the past, amend your return because they're going to give you money back.
Right.
Refundable
Right.
in your hand.
All right. I'm Esther Gullius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. We're talking taxes. You call us with your questions. We want to help you. We're going to take a short break on the other side for the news. We'll be back with your questions on the other side. Hey, everybody, this is Esther Gullius, the tax lady from EG Tax. We had a text that came in and said I spoke over most of my audience because of that opportunity zone credit. I will tell you there are many financial planners that are putting together sort of like a limited partnership. So you can, if you have capital gains, you can basically take care of that. You can also get involved in that opportunity deduction that I talked about at the beginning of the show on a smaller scale. But I wanted to make sure everybody understood that you can actually shelter your capital gains or sale of depreciable real estate. And after 10 years, it's completely forgiven if you invest in an opportunity zone, and you can do it directly because you're going to do the rehab yourself, or you can do it through some of these brokerage firms. And so if you want to call us, if you just go online and Google Opportunity Zone, you're going to see all kinds of stock brokerage firms that are offering smaller shares of opportunity zones, so you can take advantage of this deduction as well.
And I think you started to say that, Esther. It's really complicated. So if you have questions or if you need somebody to guide you through it, give us a call anytime at the office at 632-7886.
It's a brand new change in the tax law, and I will tell you, if you're somebody that didn't want to pay capital gains, and you know who you are, it's a great way to do it and a great way to rehab property. And you're going to find out that many of these brokerage firms that are putting together these opportunity zone deductions are going to be investing in other areas other than Western New York. So if you're looking at Western New York, make sure when you're talking to your stockbroker that they understand that you'd like to do Western New York if you wanted to.
Yep.
Right?
Yep.
All
That's
right.
right.
I'm Esther Gullius, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. And I was reading the other day some of the winners under tax reform. One of the big winners is going to be corporations that had pretty much kept their money offshore. And they can now bring it back to the United States, and instead of paying 37% in taxes, they are going to only have to pay 8 to 15%, and they can repatriate the income from offshore back to the United States, which gives the United States extra opportunity, extra income that goes into the United States Treasury, because that ends up getting spent here. So that's one of the big winners. And of course, everybody goes, yeah, well, I don't have a bunch of money offshore. I understand, but I'm just telling you.
Right, but
the other thing, pardon me?
That's like bringing the jobs back to the U.S.
Yeah, but this is their money. This
right,
is
but
the money, too. That's true.
Yeah.
The other thing is people that are very wealthy are going to see a 2.6% drop on the top, so that'll save them $26,000. But what we we have to understand is that a lot of the things that would have been deductible before as an itemized deduction, especially if you're located in New York State, they won't be able to take because they might have, let's say somebody has a big mansion someplace and their property taxes is $100,000. Well, in New York State, you can't take that anymore, right? So you gotta weigh it out. So it's true that they're going to pay more at the top, but they're losing itemized deductions at the bottom.
yes,
correct?
yes.
Okay. And let's see. The other thing is taxpayers with children under the age of 17. Why is that, you guys?
Whoa.
Who's going to benefit from that?
I was just doing a consultation yesterday for a client that was referred to me, and they have a child who's under the age of 17, but they have self-employment and they're making a little bit more, but really their answer is going to be better on their child tax return because if you're over the age of 17, under the age of 17, you get $2,000 for your child versus $1,000.
And it's not a deduction. I want everybody to understand this $2,000. This is $2,000 in your pocket.
Right.
So it's not a deduction; it's a credit. So you actually save $2,000 for each child that you have under the age of 17.
Yep.
Right?
And then not to mention that these folks the year prior lost their $1,000 child tax credit because it was phased out at such
Because
a
their
lower
income
limit.
was too high.
Yeah,
And
and now we're
now
at $450.
People are going to qualify for that credit with income over $400,000, whereas last year they didn't even get the $1,000 child tax credit.
Right.
So that's a big winner, right?
Definitely.
All right, and then losers are the healthcare exchanges because starting next year there's no penalty.
Right. I was talking to my class about that, and that's sad for a lot of people who really took advantage of that, and so that is going to be a big loser.
Right, but the thing is, everything has to be balanced by the fact that the whole healthcare thing. I think Congress really dropped the ball when they had the opportunity to fix Obamacare, and they just never did anything. Mm-hmm. And I think it's now become a big political football in the midterms.
Yeah,
but they didn't do anything.
Yeah.
So it's a problem. But when people think that there is no penalty under the change in the tax law, that's not true. In 2018, the penalty is still there.
Right. The exchange is still going to be there for 19 and 20. It's just if you don't have health insurance starting January 1st, 2019, they won't penalize you for not having it.
Right. And being in New York State, this is a very high tax state, as I'm preaching to the choir, I'm sure. But the thing is, there are benefits in being in New York State if you are a lower income person, because the state of New York will basically subsidize your health insurance for you. And if you have no health insurance because you can't afford it, and by the way, that's another winner. If you can't afford health insurance, the penalties there, but the exception to penalties this year are very easy to come up with. So if you just say, I can't afford it, they will let you get out of the penalty.
Right.
But going back to my initial point, if you can't afford it, what you need to do is call a healthcare navigator. You can call EG Tax. We have healthcare navigators. There are programs in New York State where the truth is, if you qualify for Medicaid, it's free health insurance. And if you're a lower income, you might qualify for the Essential Plan, which is like $20 a month. And it's great medical insurance. And so just because you can't afford it is the exact reason why you should call. because there may be free health insurance available to you,
Yeah.
right?
I wonder now that they got rid of the penalty, are they going to start carving away some of the help and the advantages that are on the marketplace? And Chris is shaking his head no. Yeah,
Well, I
which
mean,
is good.
you got to understand, New York State, I believe, will be in it as long as they have to be, because it looks to me like they were one of the few states that really bought it hook, line, and sinker.
Right. Well, we basically had it before the mandate came out, and that's what made New York State a much easier flow into it. So I don't think New York State's ever going to give up what's out there.
Well, I mean, you can only do what you can do financially, though.
Right.
You know, right? I mean, that's why there's a couple areas that New York State has for credits, and you can actually get a credit in your New York State tax return if you contribute to some of these charitable foundations that New York State has initiated, and one of them is for health insurance. Is for helping to help people with health insurance. So those are some of the changes that are coming in effect. New York State has pretty much been cloak and dagger with what they're going to change this year. Monday, you guys are going to a seminar, right?
Yep. Maria and myself are going Monday.
To a New York State seminar.
New York State seminar, and hopefully we'll have answers for people for next week.
Right.
Versus
And so
thinking
then
about what New York is
hopefully
going to do.
some of the things that they're keeping secret will let you know in advance. One of the things that is a change in New York State is this employer, I want to say it the right way, this employer credit for employers that want to help their employees who make more than $40,000 a year, and the employer is willing to pay the employees New York State taxes. The employer then gets the deduction for the taxes they paid for the employee, right? Plus a credit. Now, you would think that somebody must be drinking Kool-Aid in New York State to think that an employer would want to pay their employees 6 or 7% to New York State. I'm thinking that what the employer would do would then give that employee a pay cut of equal to what he's paying to New York State, so that the employee's net amount of income that they're getting is going to stay the same. The employer is going to get the deduction for what they pay plus the credit, and that has to be done by December the 1st.
Yep. Oh, it's a very,
It's very complicated,
Yep.
but for an employer with employees over 40,000, where you're paying the employees New York State taxes because they can no longer take it as an itemized deduction, this is the state's way of helping, okay? You're going to get a credit. You'll save on the FICA and Medicare. The employee saves on the FICA and Medicare. They're whole because what they would have had taken out of their paycheck, you're paying, and you're going to get a credit for that. But it has to be initiated by December the 1st. And once it's initiated, you can't back out of it for a year. Right?
Yep.
So, I mean, there's just all these little things, but they're
Nuances.
so complicated.
Yeah.
We were sitting there yesterday at our meeting, and there were some headlines we were reading about something to the effect that there's now a postcard, but it's harder than ever because now the postcard has 6 extra pages, and what was easier before is now harder under tax reform. And you can see, like, the state of New York is trying very hard to accommodate its taxpayers who are getting shafted because of this SALT deduction as an itemized deduction. And this is one of the ways around it. Next week, hopefully, after you go to the seminar, you're going to find out some of the other secrets, right?
I've
Yep,
been doing consultation after consultation planning with my clients, and they're like, oh my God, I got to move out of New York State. And so I think New York State is trying to be conscientious to what they're hearing their constituents
I
say.
think
but-
that their balance. New York State has been always, like, it's called coupled to the federal. What the
Right.
federal did, they let you do in the state. Now the state of New York is uncoupling many things, and so you may find out that you can't itemize on the federal, but you can itemize on the state. So those are some of the things we're going to roll out here as time goes on. I'm Esther Gulius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on the cell phone. We're going to take a short break, and we'll be back with your calls on the other side. Hey, this is Esther Gulius, the tax lady from EG Tax. And I know we're talking about stuff that sounds like we're just speaking in Sanskrit or something, but some of these changes that have taken place are very difficult to explain, and they're very complicated. So the important thing is that you get it. I mean, sometimes all you need to do is come away with and say, oh my gosh, I think we better give these people a call. And there's no charge for us to talk to you, because you want to make sure that you take advantage of everything that you can possibly do to make sure that that you don't overpay your taxes. Then I will tell you, this year here is going to be a big learning curve. Tiffany was talking about it on that commercial, that the postcard that Trump wanted, he wanted the postcard, but it won't work. It's like getting a car without an engine. So he's got the postcard, but in order for the postcard to work, there's 6 pages that have to, full pages that have to be attached to the postcard to make it work. So, you know, it's so sad because it ended up being far more complicated than anybody thought it was going to be. So that's another loser. The other thing is the federal deficit, because it's been great, the economy, but unfortunately to make these things work, he had to kind of go out on a limb, and the federal deficit going up.
I listened on public radio. They said that Trump is then asking everybody in the government offices to try to cut spending, is what he's trying. He said to everybody.
I mean, it's a balancing act.
Yeah,
you know?
and he said,
I mean, and he really is kind of a salmon swimming upstream, because whatever he does, nobody likes, you know, in the news media. But you know, okay. And so let's talk about some last things. Again, our phone number is 803-0930, 803-0930, star 930 cell phone. I know we got calls holding. Wanted to tell people, if you rent out your personal home for less than 15 days, it's completely tax-free. So let's say you have a condo in South Carolina, and over Christmas you could make $5,000 renting it out over the Christmas season, and it's your personal residence. Okay, this is where you live. So you move out of the place, and somebody rents it for 14 days. That is completely tax-free income.
That's just, you know, I know when we say this all the time, it's just mind-blowing what you can do and not pay tax. And
right. So
you know.
that's and then the other thing is, health savings accounts are deductible, and you don't have to itemize.
Yep.
Right? I mean, that is a really cool thing. So if you do an HSA, you end up with an adjustment on page 1, and you don't have to itemize. So you want to make sure that if you have a high deductible health savings account, and that you take that, and it wasn't employer sponsored, you're putting it in yourself, it's either not deductible, it's not taxable because your employer's paying for it, or it's deductible because you paid for it. And it's even though you don't itemize. Right?
Yep. And the nice thing about HSAs too is they turn into IRAs.
If you didn't spend it.
Right. So you can use it.
If you're just as healthy as a horse, you don't have to worry about it. Why don't we go to the phones? We got Mr. Bill that's been holding. Hi, Bill. How can we help you?
Hi. I tuned in kind of late. I'm just wondering, is it going to full effect yet, the $26,000 deduction, or you still have to itemize?
Oh, no. Okay. The standard deduction, if you're married filing a joint return, is $24,000.
$24,000. Okay.
Unless you're over the age of if you're over the age of 65, then there's an increased standard deduction as well. $12,000 if you're single, $18,000 if you're head of the household. So many people will still itemize, but you have lost your personal exemption. So you used to get a benefit for having yourself, your spouse, and your children that were dependents or other dependents. You used to get a deduction for that. So you're not getting that, but you're getting the larger standard deduction. And in many cases, it ends up being the same. But overall, everybody got a tax rate cut.
Okay.
So that's a good thing.
Continue to, keep track of all our donations and so on.
Right. So are you somebody that's been itemizing in the past?
Yes.
Well, so just like we've talked about in the past few weeks, we're not sure if the state of New York is going to decouple from the federal as far as the standard deduction. And if you can't itemize on the federal because of the higher standard deduction, the state of New York may allow you to itemize on the state. So this first year, it's a lot like walking blind with a cane. We're really not sure how it's all going to work out, but Chris is going to the seminar from New York State on Monday, and we will let you know next week what they're saying about that.
Just
right,
have
Chris?
to unravel the noodles, right?
Yep.
Oh, okay.
All right, so it never hurts to have the stuff in order,
Yeah.
just in case. All right?
All right.
All
Okay.
right, thanks, Mr. Bell. I'm Esther Gullius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on your cell phone. In case somebody wants to go to tax school and haven't registered yet, we have an online school too, right?
Yep, we do. And Tim Eliason is our instructor. He does a great job. And you can go every Saturday, sort of like in your PJs, and watch him and be active participant. If that's not convenient, he also tapes it, and you could do it at your leisure.
Okay, hey, Tiff, read the text. That
I
came in.
would. It says the federal government is shafting the people with the SALT deduction, right? Question mark, question mark. No, New York State is the one shafting the people with its high taxes in the first place. Other states don't seem to have a problem with the 10K cap, except for like California. They're having
New
a problem.
Jersey.
New Jersey,
Yeah.
right?
So
and Illinois.
right. So it is true. Those higher property states.
It is absolutely true that New York State, New Jersey, California, these high tax states, the problem, when you say the state is shafting them, we have elected these people that are running our states
Well
who
said.
are spending money and they need more. So they have no alternative but to increase the taxes so that they can do subsidies for health insurance. So Medicaid, when you get old, they're going to pay for your nursing home. In the meantime, your taxes are high. In the past, the federal government has said, well, we say you get to take whatever you paid in state and local taxes, real estate taxes, even though you're in a high tax state. Well, now they are capping it at $10,000, and that's one of the reasons why that new employer plan is something that you might want to have your employer talk about, because it's got to be initiated by December the 1st, and it could be a win-win for you and the employer, and it'll help you to kind of modify that SALT deduction. And I know it sounds very complicated, and quite frankly, it is. Right?
Yeah.
But again, it's going to take, I can see that what's going to happen here is that it's going to take a whole tax season where people aren't
Yes.
going to get benefits.
Right.
Because they won't know how to get them. They won't know what to do. And for instance, an over-the-road trucker who is now going to lose all of his itemized deductions
Yeah.
for all those expenses for over-the-road trucking. It's going to take a whole tax season before they go to their employer and say, wait a minute, you're not reimbursing me for my over-the-road expenses, and I can't deduct them, and I'm paying more taxes. Then the employer is going to ask the questions, and I will tell you, if you're an employer of 18-wheeler guys, the DOT guys, EG Tax will help you, and there's no charge. There is a way to do it and help make your employee happy.
And Esther, what did you say that deadline is for the employers to be a portion of
December 1st. They have to
Wow.
initiate this
Wow.
plan with New York State by
That's
December the
so
1st.
soon.
That's why here we are, almost November. So I'm going to be talking about it a lot. The employer benefits, the employee benefits. Think about this. If it's $10,000 in New York State taxes that your employer picks up for you, you take a $10,000 pay cut, okay? But he's paying in your withholding. So you're getting the credit on New York State. He's be able to deduct it. The employer is going to get a credit for it, and you're going to save 8.75% in FICA and Medicare. So the employee is going to save $875, right?
Yep.
So
Yep.
you're made whole. You're saving $875. The employer's paying saving $875. Plus, there's a credit, and that is coming into effect because New York State is trying to be empathetic to its taxpayers. And you are right, Mr. Texter, that it's definitely the state. But who voted these people?
Right, but
Right.
according to our governor, aren't people moving out because of the weather, not because of high
Right.
taxes?
It's the number one exodus of people.
Wow.
New York State, but he said it's the Western New York.
It's the
Didn't
number
say-
one.
no, he
It's the
said
number
upstate,
one
right.
exodus.
Yeah.
New York.
Yeah.
Wow.
It's the weather, not high taxes,
It said
not
upstate weather.
not jobs.
Okay.
Upstate weather.
Yeah.
Okay. Other thing, little loopholes. This year, and I tried to win the Mega Millions, and I don't know. But my girlfriend was traveling through North Carolina. That was the state that...
South Carolina.
She was traveling through South Carolina. She said that they bought a ticket at a convenience store, and then they read the looking online that somebody had won in South Carolina, and they thought, oh my gosh, it must be us. But they didn't win. Neither did I.
Wow.
But anyway, one of the changes in the tax law that people don't know is that there's deduction for people that are gambling. If your losses haven't offset your winnings, you can now take travel
Yep.
to like Vegas or wherever you go.
If you take a bus or a plane.
Right, so that's a new change. You can also borrow from your life insurance, and so those people that are having financial troubles, they don't know where to look. If you got a life insurance policy with a cash surrender value, that's a place to
Have
look,
at it.
right?
Yep. Yep.
And the other thing is, don't forget that just because somebody told you to put money into a Roth doesn't mean that that's what you should do, because many people, as the standard deduction is increasing, really seniors are not going to pay, as in the next couple of years, up to $30,000 is going to be completely tax free. So if you kind of didn't put money into a traditional IRA or pension plan up front, and then you go to take it out, you're not going to pay it.
There was
later.
there was a text question, but it's too late. What about union reps? Are expenses for them deductible? And the answer is no.
No, sir. No, sir. Nope.
That whole section is gone.
Finito.
Adios until, we'll see. Until next week, I'm Esther Golias, the Tax Lady, with Christopher Fabian, Tiffany Fabian, and EG Tax. Go to our website at egtax.com. Until next week, if you need us, we're around the corner. We'll be able to help you as much as you need help. Give us a jingle. Until next week, I'm Esther Golias. Bye-bye.